Basically, it's, someone owns a house, wants to buy another house, doesn't have enough time to go to the bank, or maybe their FICO score is 2 points lower, something silly like that, right? So we help them buy the next house, and then they have time to sell their current house, fix it up, et cetera, and can compete with all cash buyers, et cetera. There are a lot of hard money lenders out there, but there aren't too many who are even licensed to do these owner-occupied consumer loans.
Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. All right, imagine that you live in a beautiful house, which you probably do, and you found another house that you want to move into and the market's nuts. You got to buy that house. Well, what do? Do you buy that house at the same time sell this house and deal with buying one and moving into the other and the inaccuracies of when it's going to close and delays and issues? There is a solution for it. And Edward Brown, my next guest, is a specialist in that. It's called Owner-Occupied Consumer Bridge Loans. He helps you buy that next house and be able to afford selling the other house in that median time. His lending company specializes in this, and we share a bunch of ways that you can take advantage of this if you're in some of the markets that he's in. It's also a very interesting lending model to be able to provide. There's not that many people that do this at all, which is one of the reasons I wanted to have him on the show. For over the past 20 years, Edward Brown was CEO of a $40 million alternative lending company based in Martin County. Today, he assists Pacific Private Money with capital raising and investor presentations. Edward is also the host of 2 radio shows, The Best of Investing with Mark Hanf and Sports Econ 101, a national sports and business show. Edward earned his Bachelor's of Science in Accounting and an MS in Taxation from Golden Gate University and has held licenses and certifications including real estate salesperson, insurance license, Series 7 security license, tax preparation license, and certified fund specialist. Super smart dude. I love having people like this on the show that are in a specific niche, know about it, can actually share how they got their numbers, information, the regulations. I'm a law school graduate. I'm all about doing things in real estate safe and clean and beautifully. You want to have a garden that is properly regulated. I hope you do enjoy the interview. Check out our website, rei.mba. I have a bunch of tools on there that will help you along your journey, including a real estate roadmap that lays out podcasts to help you go along the way. And I love you guys. iTunes, Spotify, Stitcher, rei.mba. Enjoy the interview. Mr. Brown, thank you for being here.
Tejas, good to see you.
Thanks for making the time. Appreciate it. I caught you right at the perfect moment, sipping a cup of coffee. Sorry.
That's right, exactly. It's actually water.
Oh, there you go. Thanks for being here. We got a lot to get into. First, can you give me a quick intro on yourself and bring us up to speed?
Okay. Edward Brown. I handle investor relations at Pacific Private Money. My background is I've got a bachelor's degree in accounting and a master's degree in tax. For many years, I had my own tax and financial consulting business, and then got into the mortgage business in the early 90s, and then started my own company with a business partner doing hard money loans. Hit 2008 when unfortunately we did some land deals, and then I hitched my wagon to Pacific Private Money after Mark Hanf and I did a radio show. We had our own radio show starting in 2010, and we actually had never done any business together. We had just done the radio show for 3 years. And when he finally wanted to start a fund, he asked for my help because I had my securities license and real estate license and all this stuff. So I had a lot of experience to bring to the table, and I've been with him ever since.
It's amazing. And that 2008 period must have been very interesting, like it was for all of us.
It was, yeah. There were some blessings that came out of it, but unfortunately, it's like, it says the buck stops here. I mean, unfortunately, I let my other business partner kind of make some decisions on some deals that I was a little hesitant on, but I can't run away from my responsibility. So I've got to buck up and take it like a man, and unfortunately, I got caught up in that too.
Well, here, you have a lot of experience and you've been in all these different facets. I have my real estate license too. I manage a private equity fund, took a long time to build. That's why I like to have people like you on the show. You know a lot about what's going on, and then you have specific strategies that are helping
Yeah.
people. I'm an all multifamily guy,
Okay.
and that is my favorite asset in the world. And you have your specifics. Can you share, what your niche is and how you've been helping people?
I'd say that we're nowadays it's more like the soft hard money instead of the hard money. Our special niche, I'll call it, because it's not the only thing we do. I mean, we'll do multifamily, et cetera, but our specialty is the owner occupied consumer bridge loan product. And the reason that it's kind of specialized, I think, there's only a handful of us in California licensed to do these owner occupied consumer bridge loans. It sounds very specific, but basically it's, someone owns a house, wants to buy another house, doesn't have enough time to go to the bank, or maybe their FICO score is 2 points lower, something silly like that, right? So we help them buy the next house, and then they have time to sell their current house, fix it up, et cetera, and can compete with all cash buyers, et cetera. There are a lot of hard money lenders out there, but there aren't too many who are even licensed to do these owner occupied consumer loans. You call a lot of them and they'll say, oh, wait a minute, you're going to live in the house? Oh, no, I'm sorry, we can't make the loan. And people ask me, well, why aren't there more of them? And I think the reason, this is my own personal feeling, is that it's a fairly expensive barrier of entry with the licensing, continuing education, legal, and software. I mean, it could cost upwards of $100,000. So, if you're a typical hard money lender, you're doing pretty well by, making money, et cetera. Why do you want to spend an extra 100,000 to get into a new space, right? So we decided to do that. And it's been very interesting lately because people have asked, well, yeah, but what about the real estate market today? And, things are, not as busy, et cetera, and contracts falling through. Actually, we are busier than ever. And I think the reason is because we've become even a bigger fish in a smaller pond, because a lot of mortgage companies have downsized, right? There's been such little refinance market with the interest rates going up. There's a smaller pool of money out there. So we get a lot of referrals from banks, mortgage brokers, realtors, et cetera.
Yeah, I was going to say realtors. Back when I did residential real estate, that was
Yeah.
always the biggest problem.
Yeah.
Somebody so tell me, what makes the regulation so expensive or difficult?
Well, first of all, you have to be very accurate with your numbers, and that's where the software comes in. Because if you're off, there could be a lot of penalties. So you have to fit within the Dodd-Frank rules, and we have a few ex-bankers as underwriters. So they know the rules really well. And again, that's where the continuing education comes in, and all the legal, and then you have to get the NMLS license and keep up to date on that. And it changes all the time. So I mean, I'm glad I'm not that part of the business. My part is raising money for our we have different funds.
Yeah. So yeah, tell me about that. Well, actually, before we move on,
Yeah.
because people are in a funny spot and the economy is in a funny spot and inflation and everything, you're saying this is a busier time. So people are selling their homes and
Yeah.
they're successful. You're seeing that in some specific pockets or
Yeah, we primarily work in California, but we are licensed outside, so we will still do some loans outside of California. But California is still a fairly big market,
yeah.
and there's still a lot of movement. People either having to come back to work, and so they have to move, or they're selling their second home and wanting to buy another. I mean, there's always activity going on. And the interesting thing is the interest rates. I mean, we've had to raise our interest rates to our borrowers, and that converts to raising interest rates for our investors, which is a good thing.
Right.
But the delta is not as big as it used to be. So, the Fed raised their interest rates faster than we raised ours. And primarily, I think it's because it's a supply and demand situation where there's still so much money in California that, people would look and they would, back in the couple of years ago, let's say before COVID, money was cheap in California. And so, you maybe do a loan, let's say in, I'll just pick a state, Iowa, and maybe, the interest rate was 12%. Well, we were only charging 7%. Because there's just so much money chasing the deals, right? Well, now it's kind of eased off a little bit, and so we're having borrowers come to us where we're charging them closer to a little over 10%.
Sure.
And even though it sounds high, there's no prepayment penalty. That's the other reason that I think a lot of lenders don't touch the owner-occupied space, is because you can't do a prepayment penalty on a consumer loan, and so they don't want to put the money out there and then get it back really quickly.
Right.
Because we charge points up front, it makes it worthwhile to us. If we're going to charge 2 to 3 points, let's say, compared to some of these lenders were charging 7% and a half a point. They don't want the money back that fast, right?
Right. No, that's amazing. So, I mean, big deals then. They're not small deals that you're working on over there.
No, our average loan's about $1 million.
Okay.
Yeah.
So your clients are successful, and then they get out of your loans and they're happy and they refer their friends over.
Yeah, exactly. Now, here's where the interesting thing, before we started recording, I told you we had a very unique product.
Yeah.
So the main funding for our owner-occupied consumer bridge loans is one of our funds called the Freedom Fund. And like I said, I've been in this business a really long time, and I've seen a lot of cycles, et cetera. And even when I ask even competitors, I ask them, I said, do you have any kind of product like this? And they say, no, we don't. And here's what it is. So we primarily sell off our owner-occupied consumer bridge loans. We have a few big institutions who buy our loans. So the object is we do a loan, put it on the conveyor belt with a bunch of other loans, sell them off, get the money back every roughly 2 to 3 weeks, and start that process all over again. Because of that, we have the typical Reg 506D type fund. All funds, if I remember correctly, have to have a 1-year lockup period, in order for them to qualify for a loan for a fund, right? However, we don't charge any early withdrawal penalty. The only thing we require is a 30-day notice, because we're not constantly keeping a bunch of cash in the bank at the time, right? Because we have to earn money on it. So can you imagine, this is very similar to a money market account, but you can't write checks against it. And it's not FDIC insured, but it's backed by the loans, which are constantly revolving. So the interesting thing is, from a risk standpoint, we're in and out of these loans very, very quickly, right? We're just holding them for a couple of weeks. So it's not even really enough time for a borrower to default.
Right. Yeah, that's amazing.
In most cases, there's not a buyback provision. So the institutions say, if you do these loans that fit within this box, we will buy them, right? So we have various contracts. Even when the contracts run out, they still are interested in the loans. So the big benefit here is the fact that the minimum investment is $250,000. Okay, and you do have to be an accredited investor, of course. So we pay 7% on $250,000. We pay 8% if you put $500,000 in, and we pay 9% if you put $1 million in. And then if you put in like $5 million, we'll even go higher than 9%. We're just making a smaller profit. That's all. So if you put in $500,000, in fact, we just had a guy wire $500,000 in today at 8%, and he's a real estate investor. So he looked at it and said, where, and this is exactly how you should be thinking. Where else can I park my money temporarily until I need it? Right? I mean, you can find an FDIC insured bank account, which I think FDIC is still up to $250,000.
Yep.
So after that, theoretically, right, it's not insured after that, and you have to tie it up for about a year in order to get around 4.5%. Plus, all of our funds qualify for QBID. And for those who are not familiar with
Yeah, what
QBID,
is that?
okay,
There's
so
listeners who are first-time listeners.
a few years ago, a tax law was passed called QBID. It stands for Qualified Business Income Deduction. Now, not all investors qualify. If your income's way too high, then what I'm going to tell you is irrelevant. So it's really for people, and I believe the number is income of under 351,000, if I'm not mistaken, or 315. Please check with your CPA. I'm not giving any tax advice. I'm not giving you any legal advice. But what it means is that if we pay you, I'll make it really simple. If we pay you $10,000, you don't have to pay taxes on all 10,000. You only have to pay taxes on 8,000. 20% if it's tax-free, if you qualify.
Sure.
So whereas a bank CD, you have to pay taxes on the whole entire amount. So, obviously, again, we're not FDIC insured, but if we're getting loans, if we're funding loans and then selling them off, I mean, there's lots of liquidity all the time. So people put their request in, and I've seen us actually redeem in a period it only took 3 days. Because the person who wanted to redeem happened to hit it right at a time when a trade was going through. And if we've got the money, why do we want it sitting around even for a week earning 0% in our bank account versus someone who said, please cash me out? Okay, here you go. I don't want to pay 8% anymore if I don't have to.
Right. That's great.
I got to tell you a quick story. This is kind of fun.
Yeah, please.
So now it's been about 4 months ago, maybe 5 months ago. I had a guy call out of the blue, never heard from this guy, brand new guy. And he says, I've been watching your company for 2 years. I'm kind of thinking, how do you watch my company, or our company? And I guess he was on our newsletter list.
Social media. Yeah.
Yeah, exactly. That's right. Yeah. So he says, I've been watching it for 2 years and I'm now feeling comfortable enough. He says, I understand if I invest $1 million, I'll get 9%. And I said, that's correct on this fund. We have 4 different funds, and this specific fund, what we're talking about. And I said, that's correct. He said, well, I don't want to just put $1 million check in the mail, and I want to meet the people and I want to, hand it to you. So can we meet at your office? Of course. So he says, I've got a few more questions for you. I said, fine. So he comes in, we sit down for about 30 minutes. He asks some really good questions. I answer them, and he says, "Okay, well, you've answered the questions I thought those were the answers, and I'm satisfied. Can I put in 3 million?"
Ooh.
Yeah, and I said, and the thing is, I mean, we actually have enough volume to where I said yes, because if we don't have the volume, then I don't want to take his money, paying him interest, or have it sitting at 0% until we could use it. But at the time, we could actually use it. Because we're growing substantially. So he puts in 3 million. And about 4 days later, I get a phone call from him. And I'm thinking, he's got buyer's remorse or whatever, right? He says, I've been thinking more about this. He says, can I add an extra $1 million?
Yeah.
He hadn't even gotten his first check yet.
That's amazing.
Yeah. Now, I'll tell you, well, here's the thing is we did, between all of our funds, we did somewhere between 500 to 600 million. So we have
well, look,
go ahead. I'm sorry, I'm doing too much talking here. Go ahead.
I love it. I mean, you're painting the picture and also sharing a bunch of tidbits on how, people have to make money. People have issues they need to have solved. Let's, the consumer side, one thing. So funds and investors and people that you're keeping happy on that side, how many funds, what built one fund into another? Can you tell us some of that?
Okay. So before our Freedom Fund, we had our Legacy Fund, our first fund. And that was our, typical hard money loan where we did fix and flip. And then we started doing the owner occupied consumer bridge loan, but we were portfolio lenders. So we were just keeping the loans. And after, it was really kind of interesting because the CEO decided to get a credit line at the bank only for because we're basically unleveraged. The only reason he got the credit line was there were going to be times when, let's say, he wanted to do a loan for $800,000, and if we only had $600,000 in the bank, he didn't want to say no. So he would tap the credit line for $200,000, do the loan, and then as money came in, he would just go ahead and pay down the loan down to zero. So he got a $2 million line of credit. Took him a long time, but he got that from the bank. and everything was fine. This is back in, I think, 2016, 17. So everything's going fine. And then one day the bank sends him a nice little letter saying, hey, it's been fun. You've been a great client. You've been paying like clockwork, blah, 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 but we're not going to have this program anymore. And so you're going to need to close this out by December 31st of that year. And it's like, oh, okay, great. Now I'm going to lose my credit line. And getting a credit line at the bank is really kind of hard. So, he was shopping around, and then he decided to call the attorneys who he had set up his funds. And he said, is there any reason why I can't like set up my own fund that'll act as a credit line? And they said, no, you can do that. So he set up the Freedom Fund, and originally it was set up to basically replace the line of credit, right? He started getting contacts from various companies who wanted to buy our loans because our loans were very, very high quality. And at the time it was, well, no, we're portfolio lenders. But then there was so much demand for this that he said, well, why don't I just grow this fund and it'll kind of act as two purposes, so to speak.
Yeah.
And so that's how that fund grew. And boy, it grew fast. I mean,
Yeah.
I think that's up to like 45 million in our Freedom Fund, and it's only 3 years old, 4 years old, something like that.
Yeah, that was going to be my question. How long? So there's two funds or three, or how many in total?
No, okay. So we had our legacy fund, and now we're not really raising too much money in that one. We're really pushing towards this Freedom Fund because we have an outlet to be able to sell the loans. Then there's another fund where I'm actually one of the managers. It's called our Pacific Southwest Note Fund. And originally it was designed to buy discounted, primarily seller carryback notes in Texas, very, very specialized. We had a Texas partner who he was part of our group for this fund, and he would do all the legwork, and then I would approve the loans, et cetera. Eventually, it was just getting a little expensive to solicit a lot of potential sellers of notes. So we've backed off from that specific model, and we're still using that fund to buy just discounted mortgages. And we've got a few contacts out there. And so we're expanding beyond Texas. Yeah. And they're not just seller carryback, but big benefit to that fund is it just pays a flat 8%. Minimum investment's 50,000. Again, you got to be an accredited investor, but again, it doesn't have a lockup period. So you just give us 30 days notice when you want out. And I think the best part of that, because people say, well, what's the risk? I mean, everything's got, at least a little bit of risk. Some have a lot of risk, some have a little risk. So the average LTV is about 44%. The average ITV, investment to value, because we're buying these at a discount, is just under 30, or right around 30%. So we're actually, you got $100,000 value of a house. The loan's 44,000. We're into it for 30 grand.
That's
it's not risk free, obviously.
Yeah, it's very mitigated.
But it's mitigated, exactly. And so there's enough equity for these borrowers to continue to pay. Or, once in a while, if we do have to foreclose, we make a little bump, Yeah. But we just pay our clients just a flat 8%. And that's our smallest fund. It's only about a $5 million fund. And then we have another fund that just strictly does construction called North Star. And then we just recently opened up a REIT called our Opportunity Fund, which will do primarily construction loans, but it'll be kind of a hybrid. But the main difference there is the fact that it's a REIT, and if I'm not mistaken, a real estate investment trust, if I'm not mistaken, that QBID is at the corporate level. So you could be Bill Gates and get benefit of the QBID because it's done at the corporate level. I believe that's the reason. And also it gives a 1099 instead of a K1. A lot of people like that.
Yeah. I graduated law school, so a lot of stuff that you're saying, I'm in love with, because you went through so many lawyers to get to this point. And there's still first-time listeners and folks that I've been urging to get into real estate, and some people are in the fundraising stage or syndicating or something. You've done a lot. How do you keep? You have one big legal team you work with. There's a lot of regulation in what you're doing, and a lot of moving parts. Can you talk about that?
Yeah. So we have primarily our legal team who set up our funds. We do have a couple of other legal firms that we deal with from, if it has nothing to do with the fund aspect, but it's more of, let's say, foreclosing or, other issues, excuse me, out of state. But I say and then no offense, Tejas, but attorneys are like Listerine. I hate them, but I use them twice a day.
No, I love that. The attorneys are terrible, and I don't practice, so I don't have to
Okay.
call myself one.
No, but I like the attorneys who are good business people, because I've met attorneys who are deal killers,
Yeah.
and although they're very good attorneys from knowing the law, they're not. You don't really want to hire those people because you never get any work done. You just end up paying them legal fees. So I
No,
like the
you
ones.
nailed it. I've had to do so many weird things where it's a buyer and a seller, and then there's an extra 3 contracts for, something that was unanticipated, or, even in the walkthrough, like we'll have to go outside of docs to try to make sure we remedy a situation and make it through closing. But on the money, lawyers suck. Please keep going.
Okay. Yeah. So the main firm we've been dealing with is Jurasi in Southern California. They are kind of like the pinnacle of attorneys when it comes to putting funds together.
Yeah,
Yeah, they're pretty large, very talented team.
that's great.
Very talented.
Well, so yeah, the attorney part of it, the SEC part of it. So accredited investors, that's a very
Yes.
tough category of folks to represent. Very educated.
It's funny. Everyone thinks that, right? But I mean, the legal definition is net worth exclusive of your home of at least $1 million, or you make 200,000 a year if you're single, 300,000 if you're married. So you get some rich old widow who's got a $1.5 million stock portfolio and doesn't have any debt, and she's considered accredited. Now she may or may not be sophisticated, but she qualifies. So it's kind of a misnomer, or I don't really like the way the rules work that way, because technically someone should be, let's say, and obviously, I mean, we're above board and all that, but other people can take advantage of her, versus someone who's got $800,000 of cash, and that's all he's got, and suddenly you say, I'm sorry, you don't
You're not
qualify.
an accredited
Yeah,
investor.
even though the guy's sophisticated, so it's kind of silly. And also in the
So
old
happy you
days,
said that.
yeah, well, thanks.
Right. Yeah, verify investor. We use that. Yeah, I was saying the website, we use verifyinvestor.com
Yeah,
for our fund. We started internally verifying because there were some folks that didn't want to go on the
ex-
website and things like
yeah.
that.
And I figure, I mean, with my background, and it's not that complicated, but I've got a tax degree, so if we ever get asked, to like, verify this, financial statement, and because I got my accounting background, I don't, I do make people do more than just, send me an email that just says, oh yeah, I'm accredited. I mean, we do go in depth on that. So we'll
Yeah.
either go the full gambit or whatever. Go ahead.
Yeah, you gotta. And then that was the next thing. So tax, that's why accredited investors and some of the high net worth or professionals are looking for some of those benefits. But yeah, you mentioned some of that before. Tax stuff isn't going to change for a while. Your funds aren't going to change for a while. The market's changing.
Yeah.
And let's talk about that for a second. So what do you see? You have so much experience, crystal ball stuff.
Yeah.
Right now, rates are, pretty high. They say they're going to stay high for a while. Not enough people, not enough employment being lost and things like that.
Yeah. Okay. So it seems like interest rates will stay fairly high. I don't know if they'll maybe blipping up just a little bit more, but I think eventually they'll get inflation under somewhat control, which is kind of funny because, you hear these, oh, inflation 6%, 8%, everyone's going. Personally, I think it's closer to 25 to 30%. Now, not everything, but I mean, I'll give you an example. I go to the grocery store, go to Safeway, and get, in the past, I would get a 12 pack of, fizzy water type thing, right? And it would cost, let's say, $3. Now, because of shrinkflation, right? It's not a 12 pack, it's now an 8 pack, and it's costing the same $3. That's a 33% inflation.
Sure.
and that's not uncommon. I mean, anybody's gone grocery shopping sees it ain't 8%. Anyway, so going for the future, again, this is just my own personal crystal ball. I think rates will stay, somewhat high for a while. I don't think we're going to have a real estate crash, and the main reason is a few things. One, that it's still supply demand. I mean, if we had half our population drop dead tomorrow, I would change my tune. But there's still a lot of people who are, not in California, let's say, but just in the country. People are living longer. Whether you love illegal immigration or hate illegal immigration, 6 million new people need to live somewhere, and right, eventually, things, and they're not all drug dealers, right? I mean, some of these people are really hardworking people, and they'll need a place to live, et cetera, et cetera. That's the other thing. That's one of the reasons I like the residential side is everybody needs a place to live, and no matter how hard things get, I'm not going to move my family into a tent.
Right.
Now I may have to downsize, but I'm not going. I don't want to live on the streets, right? And the regulations, primarily in California, but the regulations make it so hard, and the costs of lumber and the cost of employment, et cetera, et cetera, et cetera. There's not as much incentive for the builders, even though they say we want more building, low income housing, et cetera, et cetera. They make it cost prohibitive. So as long as you have the population, slowly grow, let's say, and it can't keep up with the demand, plus the fact that real estate has come back substantially since 2008, and a lot of people did refinance their house over the last so many years when interest rates were low. They bought, I mean, I'm a good example. Okay. During COVID, before COVID, I had a 2.78% rate on my house, and it was going to come due in 7 years or something, 6 years, something like that. Well, during COVID, rates came down, and I took a chance on an internet type company to refinance. And I said, you know what, I'll waste some paperwork time. I go, I don't know if it's real, and it's only going to cost me $500. If I get the loan, and
Right.
I thought, I'll give it a shot. Sure enough, I got my loan refinanced. I'm now at 1.99% fixed for 15 years. Now I had to do a 15-year. And it was, a mini jumbo type thing. So you look at someone like me, and unless I have to sell because, I have to move across the country for a job or something like that, do you think I'm going to get out of that 1.99% rate?
Never.
Right? I mean, if I have to go to a different house, unless I'm going to pay cash for it, my new rate's going to be 5.5%, 6%. Right. So I'm building up a lot of equity, and my house went up in value like everybody else's house, right? So I don't see prices plummeting. Now they are, there was a time when they'd have to level off because they went up a little bit too high too fast, which I really don't like. I like it to be slow and steady,
Right. Wins the race.
So that's yeah. And now the other part is the unemployment part, where if you have too much unemployment, then you're going to have a whole shift. Like right now, one of the benefits that's going on in our Southwest Fund is the fact that now that a lot of these moratoriums are off, and because of inflation, et cetera, you are going to start seeing more foreclosures out there. I guess I don't know if I could say really on the lower end, but maybe, because our average loan in our Southwest Fund is only about $50,000.
Oh, wow.
Yeah. And again, because everybody needs a place to live, the mortgage payments, $500-600.
Yeah.
These borrowers, they don't want to lose their house because the rental costs them $1,200.
Right.
So that's why, again, I don't really see I don't see a real estate crash right now. But I do put a caveat that I have the right to change my mind if things change, right? I mean, as of today, I just don't see that happening.
That's awesome, though. No, I needed to hear that. I appreciate your professional opinion. It's nice to have somebody as educated as you to say it eloquently. Last question: how do you stay motivated?
It's funny. I was just talking to my kids about this. I love working. I really do. I actually am one of those strange people. I love looking forward to Monday mornings. I say I get to go to work for a whole week.
Yeah. How old are your kids?
In fact, my son he was here because we were celebrating his birthday. He turned 31, and my daughter's 25 and a half, call it. And
Bravo.
they're both smarter than I am, so that's good.
Yeah, sorry to
Somebody
interrupt.
keep up with the business. Yeah, but anyway, I don't think I'll ever really retire. I mean, I love what I do. It'd be one thing if I was digging ditches, and as you get older, you can't do that as much. But as long as my brain works, I love sales. And even though I've got an accounting background, accounting mind, I'm more of a people person. So, I've got the knowledge, but I like this. I like sales.
You can tell. And it's great. You got a smile on your face. I love it. Thank you so much for the time today.
Absolutely.
Yeah, we went a little over. Sorry,
Oh, we
producer.
did. Okay, not a problem.
It's a good thing. Who cares?
Yeah.
I run the show.
I'm the same way. I actually have 3 radio shows.
Oh, wow.
And yeah, so one of them's a national sports and business show.
Tell me
So,
about it while we're here. What is it?
yeah. So Sports Econ 101, one of my co-hosts is a well-known sports newscaster in the Bay Area.
Yeah.
We've been friends for a long time. Another one is a former son of a former baseball player for the Giants. And so it's just a bunch of guys sitting around the bar having drinks without the drinks, talking sports and business. And so, we'll try to get as much of the business aspect of sports in there.
Yeah.
But then sometimes certain things happen, like Super Bowl, so you talk about what happened at the Super Bowl and that sort of thing. So there's that one. That's nationally syndicated. So we have a couple 100,000 listeners around the country. And then I've got the regular business show that I've had with Mark Hanf since 2010 called The Best of Investing. That airs primarily in California. And then we started a show with a group who does the discounted loans, where they buy discounted loans from Fannie Mae and other ones. And that's on a major station in the Bay Area on KSFO called Real Estate Mastermind Live.
So you got the marketing down, funds, you're all over. I love it. How does somebody get a hold of you specifically?
At Edward at pacificprivatemoney.com. That's probably the best way. And it's funny. People say, well, where are your talents and where do you? I'm a very good salesman. I'm not a very good marketing person. So, no. I mean, what I mean is, like, if you put 100 people in the room, I'll sell 99 of them, and I'll eventually sell that 100 person, right? But my talent doesn't lie in how do you get 100 people in the room? What do you go not door to door knocking? Hi, would you like to come to our seminar? Right? I don't have that expertise. Yeah, that's true. But a lot of networking.
Well, listen, I love it. I love it. Thank you for being on the show. Thanks for your time.
Tejas, thank you very much for having me.
It's Real Estate Investor MBA, Tejas Gosai, iTunes, Spotify, Stitcher. Check out our website, rei.mba. Thanks a lot. Cheers.